Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. All right, everyone. It is the next Friday for Investment Fridays with Mr. Brad Haines of Juncture Wealth Strategies. And today we're recording right now on August 31st. It's 4:38 p.m., just to timestamp it. And again, I'm here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Brad, what's up, man?
Good afternoon. Good afternoon. Not much. Markets are not up today, which they were earlier. So that's always a fun little twist late in the day. But yeah, I mean, things are going well. How are they going for you?
Good. We just got a rescue dog the other day. So that's the excitement in my house right now. We have a 3.5-year-old black lab. His name is Leaf. And we've had him since he was like 8 weeks old. We got him at like right as soon as the shutdown happened, basically in March of 2020. We're like, we're going to be home. We might as well get a puppy. And as did millions of other people.
Fantastic.
So, yeah, he's been our only dog for 3.5 years, and we decided we should have one more. So we rescued an older dog, and she is very sweet, and her name is Violet, and she's a lab mixed with something. So
Labs are great dogs. You cannot, is she black, chocolate, or yellow?
She's black, and she has a little bit of white on her chest and paws. So if it's a purebred lab, they don't have any markings. So she has, maybe greyhound, maybe whippet, maybe, something along those lines. Maybe a shepherding dog. She'll nip at Leaf's ankles a little bit.
You're not going fast enough.
Right? Go. Yeah. So that's the excitement this week, is integrating a new dog into the house.
Oh, that's so exciting.
Yeah.
I'm a huge dog lover. So I am all for more dogs. My sister told me this week, 4 is too many. So don't get 4. And I'm like, okay, good to know.
We had 4 at one point. We had 2 Chihuahuas when we were very first married, even before we got married, my husband and I. So back when we were like 20. And so we had 2 Chihuahuas. They were hilarious. And then we really wanted big dogs, though. We didn't want little dogs. We just had them because we lived in an apartment. We loved them. We kept them their whole lives. But we added 2 Labradors as well. So we had 2 pairs for a while.
That happened.
But I don't think we're going above 2 anymore.
No, I've got 2 Frenchie bulldogs for everybody out there. I've got 2 little Frenchie bulldogs, 18 months old, a boy and a girl, and they're all I can handle. They're fantastic. They give me so much loving, so I'm very excited about them. In fact, they're with me right now. They're always with me throughout the day. So,
so sweet.
Yes, they give me support.
Right, on those hard trading days, for sure.
That's right.
So what's going on in the markets this week? And we have a really good topic that we're going to talk about today. So tell us what's kind of happened. And you weren't with us last Friday, so we've got 2 weeks. So what's happened over the last couple of weeks? And then we're going to talk about price to earnings ratios, PE ratios, and what they mean and why we need to pay attention to them. So that'll be our little education feature for today.
Correct. So over the last couple of weeks, the market, generally the equity market, has started to rebound. People are starting to really dismiss the possibility of having a recession in the United States. Jerome Powell, we had the economic symposium in Jackson Hole late last week, which in essence, what he said was, we're going to conquer inflation, but as soon as we're there, we're going to stop. And then we're going to keep interest rates at that high level long enough for us to be very, very confident that inflation is no longer a problem and that the U.S. economy is on a solid, sustainable path. So that, coupled with on Tuesday, we got the JOLT survey, which sounds a little weird from growing up in the 80s. Everybody remembers Jolt Cola, which was the first hyper caffeinated soda.
Right.
You know,
Predecessor to energy drinks.
yes, the predecessor to energy drinks of today. But the JOLT survey is job openings and layoff turnover survey. So essentially, they go out and they ask companies, hey, how many jobs you have available, how many people are you laying off, and what kind of turnover are you experiencing at your firm. And they do that with thousands of firms. And so then they combine this all into a survey result. And one part of that survey result is how many available jobs do you have open that you have yet to fill. And that came in on Tuesday much lower than was expected. So to give everybody perspective, at one point we peaked around 10.5 to 11 million jobs in the US economy. Now, put that in perspective, we only have like 5.5 million people unemployed. So it was basically 2 jobs for every person unemployed in the US at the peak. Now, on Tuesday when it came out, it was 8.2 million jobs available. So it's come off quite a bit. And that ratio has fallen from 2.2 jobs per every unemployed to 1.5 jobs for every person unemployed. Still really strong. I mean, that is a really, really strong market, but yet it's showing signs of softening at the beginning. And as we talked about, labor markets are generally not the precursor, but they're the lagging effect. They're the last thing companies want to do is lay off employees. Okay. They are forced to do it generally because they have to right size their business, or they just have to lower costs in certain ways. And often many businesses, labor is your biggest expense. So that's part of the reason people are starting to see, well, it's softening, but how much is it softening? What's the trajectory? And when it goes to interest rates, the Federal Reserve is going to continue to have high interest rates until the labor market weakens pretty significantly. Meaning, instead of having 1.5 jobs per unemployed person, maybe it's 3/4 of a job, 0.75 jobs per unemployed persons. Now, a couple things could happen there, right? We could have the available jobs come down quite a bit, and we could have the number of unemployed come up a little bit, and that could right size that ratio pretty easily. Now, don't shoot the messenger, but right now we have unemployment of 3.6%. That is a very, very, very low unemployment rate. That means the market is too strong. It's just too strong for labor. So there are going to be some more layoffs coming. There are going to be some available jobs being cut. And that is actually, for all of us as the overall economy, much more sustainable from a long term. Now, the reason why the Fed is looking at that and saying, hey, we need to wait until the labor market weakens before we start to stop increasing our interest rates is because when you have the labor market this strong, what happens is you start to see the signs of a self-fulfilling prophecy, in the sense that you have high inflation, and then your employees come to you and say, hey, we need more money. We need higher raises to compensate for the higher inflation. Makes sense. Well, what happens is when their current business doesn't do that, they leave, they go to another company who does give them a massive raise. And that has been occurring in the economy over the past couple of years. So they want to dampen down that competition where, that the labor costs can spiral out of control, because again, as everybody gets raises, it increases their spending, which increases economic growth, which increases inflationary pressures. So it's just one of those things that we have to watch out for. It's one of the reasons the Fed, even though inflation has dropped to 3% on the CPI year over year, they're still maintaining their tight monetary policy, still coming at it, still attacking inflation. And so that's where we remain today.
Interesting. And with you mentioned, the ratio could come down by employers just not posting job openings. And that's interesting that there are more than just one mechanism or one lever, right? Because before,
Absolutely.
or the other things that we've been hearing are more, there just needs to be more unemployed people. But if the ratio could come down the other way too, where there's just not as many job openings, that I don't know, somehow that clicked differently in my brain that time when you said
Yeah,
that.
I mean, if you have all of a sudden 4 million available jobs, okay, so let's say available jobs cut in half. So you have 4.4 million jobs, or basically 4 million jobs outstanding, and you have 6 million people unemployed, or there's unemployed workers looking for work, but there's 6 million. There you go.
Mhm.
That's your ratio. That's more of a, it's not necessarily out of balance. The labor market isn't so strong. It allows it discounts the pressure, the wage pressure that businesses will feel. Therefore, their margins will be protected. Therefore, U.S. equities, their earnings will have a better probability of growing, and therefore the U.S. Stock market will continue to grow and make gains. So that's kind of some of the thought process there.
Interesting. So let's go, since you just mentioned earnings, let's go to that and talk about PE ratios.
Okay.
Now, I think a lot of people have heard that term, right? Because it gets thrown around in the media somewhat. And if you follow, if you've got an iPhone and you've got your stock app and you go through, you're going to see that language. That doesn't mean, that it's necessarily easy to understand. So what is a, explain like I'm five version of what a PE ratio is first, and then what does it mean and why do we need
Okay.
to watch it?
PE ratio, which people may have heard, is the price to earnings ratio. So it's essentially the stock price per share divided by the earnings per share of that company. And it's what we call a valuation metric. It's a metric by which you can know whether a stock is cheap or expensive relative to their earnings that they're currently generating. So at the outset, most people say, okay, well, you obviously want to spend less for a dollar in earnings than more. And sometimes that works really, really well. In fact, if you're looking at the overall marketplace, generally, if you buy at lower PE ratios, meaning you're spending less per dollar in earnings, generally that works out very, very well, particularly if you're very widely diversified among stocks like that have those low PEs. Okay. Tends to be called value type investing. Okay.
Okay.
Which has done very, very well. Warren Buffett has popularized that type among others. However, there is an exception to those rules. And it's something you had talked about a little bit, Hannah, is perennially you seem to see these companies that have very high PE ratios, so they look really expensive on a price to earnings ratio or PE ratio basis. Why is that? Why do we tend to typically have those type of companies always around? And one of the reasons is because a PE ratio only measures the price to today's earnings. So the earnings over the past 12 months per share. That's all it tells you. It does not tell you how fast they're growing those earnings. So for example, if you're in two situations, one is if you're in a technology company that is innovating, that is introducing a revolutionary technology product, they typically trade at much higher PE ratios because their earnings are going to grow into that PE ratio. So if you look 2 to 3, 4 years out in their earnings per share, that PE that seems really elevated right now can actually be really inexpensive. So it's one of the things that in a growth type company, that's one thing you have to be really careful of, that you don't make an erroneous conclusion saying it's trading at a high PE, therefore I should never invest in it. That typically you have to do a little more work than that and forecast out, 5 years in the future, their earnings and see, does it make sense? Does it not make sense? Some do, some don't. Another situation like that is where you have a energy company that has just gone through a boom. Okay. And now you have a PE that's very high because oil prices have been high. Lots of investors have recognized that oil companies were a great buy, and those oil companies went up significantly on a PE basis. So when they're starting to trade higher than they normally do on a PE basis, or higher relative to the index, that's something you need to be a little careful of, because generally what happens is their price will generally fall a little bit relative to the PE, their historic PE. So it's just some things that you want to keep in mind when just looking at PE as a valuation ratio. But generally speaking, value or low PE purchases are generally a better indication, particularly if you're doing that on the overall market.
So let's actually like put that in numbers though, so people can understand a little bit more. So what's a range of a low PE versus the range of a high PE? And I know on the high side, it can it can get really crazy.
You can get really lofty.
Yeah, I've seen some really, really interesting ones. I've seen, I want to say this sounds crazy, but I feel like I've seen stocks in the 200s.
Yeah.
Okay,
yeah,
good.
for sure.
Like I'm not misremembering that, right? Like it seems
no,
anomalous.
you're not at all.
But yeah, what's a low PE?
Hold on here. I'm trying to find there's a chart by a company called Crandall and Pierce, and it talks about your PE and then your subsequent 15-year returns on the equity markets. And so what it shows is, generally speaking, is that lower PEs generally lead to, in fact, I want to share this if I could.
Yeah, let me make that possible here. So if you're watching, if you're just listening, we're actually going to look at a chart here and kind of explain what we're looking at. And if you want to see it on YouTube, you can always go to the YouTube channel and check it out there.
I'll walk through this verbally. All right. So all right. Forgive me just a second.
All good. Takes a moment sometimes.
Yeah, it does. So apologize. Okay. So you're looking right currently, for all those who are listening, we are looking at a Crandall Pierce chart that on the vertical axis is the subsequent 15-year period, okay, and annualized returns. And on the horizontal axis, we're looking at the S&P 500's price to earnings ratio, okay? And what it shows is there's a bunch of, it's a scatter plot, so it has a lot of different plots of, different price to earnings ratio for the S&P 500 that range from essentially 6 to 30, 31 maybe, okay, on the PE ratios. So that is for the overall market, all right? So to answer your question, Hannah, generally the overall large cap S&P 500 marketplace for equities stays in the range of 6 to 30, okay? Individual stocks, though, can definitely trade at over 200 times although very unlikely that they do. I mean, there are some that do trade that high on a periodic basis because they go through massive expansion. For example, Moderna had a very, very elevated PE prior to the COVID, as investors were like, "Whoa, they're going to have a COVID," and it was a smaller company, unlike Pfizer or the like. So it traded at a very, very high PE. However, that rapid earnings growth backfilled that PE very, very quickly. So it dropped significantly.
Okay.
But that scatter plot is sloping down to the right. So there's a regression line in there. It's a red regression line. And essentially what that says is for every PE, or for whatever PE we have today, it indicates right around where your return on that index, the S&P 500, will be for the next 15 years on average. So what that means is today we have a PE of 23.5 on the S&P 500. Okay?
So is that an average of all the companies on the S&P? Is that how that works?
That's exactly right. It's a weighted average. So it's every position's PE times their weighting in the index.
Okay.
So it's very tilted towards the very, very large mega cap type companies, which now are almost all technology and consumer discretionary stocks. So it's very hefty that way in terms of and that's why the PE is so high.
Yeah, I was going to ask if that's why it's trending up at that higher range right now, because that's at 23.17 is what it's saying.
Yeah, exactly. This is as a couple of years ago, but it's so 23.5 is essentially where we are today. And if you can see that, what does that say our average return on large cap stocks in the US is going to be for the next 15 years on average?
That's showing almost 7%, a little less than 7.
6 to 7%. Let's call it that range. Okay. Now, what's the average rate of return on the S&P 500 from 1927 to now, or 1929 to now?
I thought it was more like 8.5.
Okay. Yeah, it's 8.5 to 10, somewhere in that range, depending on how you measure it. So a lot of people like to say, oh, the equity market gives you an average of 10% per year. Okay. So if this is the case, we have just gone through a 10-year period. The S&P 500 has just killed it. It's been the leading market by a lot. Okay. Mm-hmm. A lot of the large cap growth companies, the technology companies, they've added so much to the valuation of the S&P 500 that is actually, it's very unlikely that the S&P 500 will continue to do well over the next 15 years. In fact, this chart is telling you it's very unlikely that we're going to have double-digit returns on average for the next 15 years. So does that mean it's a bad time to buy? Not necessarily. There's lots of other types of stocks in there. Okay. There's small cap stocks that are trading at a 15 PE. Now, if you come down here to 15 and you take that up to the regression line, you're averaging 12 to 14% per year for the next 15 years. That's phenomenal. That's where you'll start to get these excess returns starting to come in, and you'll start to have more normalized return, where small companies, which historically over a long period of time have outperformed large cap because they are riskier. Okay. Mm-hmm. And so they do offer a better rate of return. Well, because of because the Federal Reserve suppressing interest rates for so long, large cap growth companies have done extremely, extremely well. That again has reversed itself in the last 18 months, with interest rates going from essentially 0 to 5.5%. So now we're back to a normal market. My expectation is small cap, international, some of the emerging markets are going to do fairly well over the next 3 years.
So that's a really interesting point because we've talked about that before too, right? That the interest rates themselves are a huge factor in economic growth from the business's ability to get funding, basically, right? And so if the interest rates we talked about earlier, they're talking about keeping them the same for a while. We're still at like a historically not high level though, right? Like when we're talking about like historic levels of interest rates, even at 5.5%, we're still just kind of getting back to normal versus, being on the high range. Um, so when we talk about it in those terms, if it comes back down, is the market actually expecting interest rates to start falling? And if that were the case, would we be like shifting back towards large cap again?
Yeah, so that's a great question. So what's interesting today from other times where we've had interest rates this high are yields on U.S. Treasury notes, 10-year notes, typically are 6.5% when we have 5% interest rates. So short-term interest rates 5.5%, 10-year Treasury note generally 6.5% during this time. But as everybody knows, we talked about this in an earlier podcast, we have an inverted yield curve or a flatter yield curve where it doesn't really slope up that much.
Mm.
Couple reasons for that. But let's just assume that interest rates are going to start to fall second half of 2024, which is what it's expected in the market right now. The futures markets for the interest rates are saying, hey, second half of 2024, we're going to have a 1 to 1.25% reduction in interest rates. Fantastic. Generally, that will benefit smaller companies much more. Okay. Because interest is generally a larger percent of their of their expenses. And so they're the ones that suffer when credit gets tight, when interest rates go up. They're the ones that suffer the most. It's one of the reasons I looked at. So the Russell 2000, which is a proxy for smaller companies, is up 15% from its low in the last 52 weeks. So the last year, it's up 15% from its low. But it's still off 21% from its prior high. It's 52-week high. Okay. So it's basically a third of the way back, still has 2/3 more to go to get to that all-time high again. And part of the reason, high interest rates. Whereas large companies, and I'm using the Russell 1000 index, which is the largest 1,000 companies in the US, is only 6.5% from its high, and it's come back 26% from its low in the last 52 weeks. Wow. So it's almost all the way there. Like there's not much else, or it's like 6%, 7% from its high. Unless we get a lot of really good earnings growth, probably not going to maintain that high or even go to a new all-time high, unless, again, something else happens. Whereas I think the better bet is those small companies that have not, they're still 2/3 away from their all-time high. And if interest rates start to get reduced second half of 2024 as expected, their earnings are going to grow much faster than the large companies. So that their earnings should grow faster, which means their equity prices should go up more.
Interesting. Okay. So in terms of PE ratios, again, just to kind of recap that what we talked about, the price to earnings ratio is how much the stock price is in dollars divided by the earnings from the last 12 months per share.
Yep. Exactly.
And when you're looking at long-term growth, generally the lower PE. So in that, you know, it seemed like 10 and lower or 12 and lower was where there was like significant return in that 12 to 15% range when you're looking at a longer time frame. And as we go way out on the scale to that, 25, 30, it starts to come down quite a bit on that scatter plot. It was down at like 4% or less.
Exactly. You're exactly right. So one thing I tell people is, look, PE ratios can be really very difficult to think about because we don't measure anything else in our lives like that.
Yeah.
So sometimes what I do is I flip it upside down. Okay. So I take the ratio, I flip it upside down, or I take the inverse, however you want to look at it. And now earnings are on top, the earnings per share is on top, and the price is on the bottom. What that gives you is a percent. Okay. So now you have a percent. Okay. So for example, the S&P 500 right now at 23.5 PE, they have what we call an earnings yield, which is just flipping it upside down. The earnings yield is about 4.25%, 4%. Okay. 4.25%.
Okay.
Why is that important? Well, because it makes it easily comparable. So for example, if someone's saying, I'm looking at a CD, a 1-year CD, okay, I can get a 1-year CD at 5%. FDIC guaranteed, beautiful, no principal risk, no volatility, just a consistent income of 5%. Well, right now you're buying the S&P at a 4%. Okay. So which is better? So you can compare how expensive are stocks compared to a fixed income alternative. There's a popular model in the financial markets that compares that earnings yield to the 10-year treasury note. So right now the S&P is at 4.25, and the 10-year treasury note's at a 409, so 4.09%. So not much difference. So the way you interpret it is, do I want to earn 4.25% over the next 10 years, or do I want to earn 409 from a virtually risk-free rate in the 10-year treasury note? It kind of gives you a comparative basis. It's a little easier instead of a PE where you're like 23.5, is that good? Is that bad? I don't know. You can flip it upside down, use it as a percent, and look at some alternative investments, alternative fixed income investments.
Yeah, so that makes a ton of sense, because if we were at a PE of 15 instead, what would that one be?
Doing the quick math?
Yeah, doing the quick math.
All right. It would be
6 2/3, 6.67.
Yep, 6.2%. Okay. Which again, far superior to 4.09%. Because essentially what that's saying is, and this isn't exact, so this is high level, easy rule of thumb type stuff, is I'll earn 6.2% per year for the next 10 years, and the 10-year treasury note can only give me 4.09%. Well, that's a 50% difference. Right. So I'm willing to take the risk in the S&P 500 and go forth on that basis, if that makes sense. Now, again, I'm using this as a rule of thumb because you're not going to earn 6.2%. You're probably going to earn far greater than that because of other things that go into the total return of a stock portfolio. But it gives you a high level basis as to share, compare it to stock, a large, very well diversified index to the bond market.
Okay. Yeah, that really helps, I think, just to give it a new context. So we can, because that's more applicable or tangible, right? Like I can conceptualize that more easily than, just the arbitrary number that is PE ratio. So awesome. Well, that was super interesting. And if anyone, again, as we always say, if you have any questions, if something else, comes up on your news feed and you say, hey, what does that mean? Like price to earnings ratio, or what's beta, or what's a Sharp ratio, or, what does alpha mean in financial markets? Like anything, if anything comes across and you say, I want to know what that means, let us know and we'll talk about it here on the podcast next week. So, Brad, thank you as always for being here. And
You're welcome.
we will see you next week.
Sounds good. Thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.